4th of September, the RBI mandated that all new floating rates for personal and retail loans, along with loans to the MSMEs, should be linked to an external benchmark from October 1st. Now, this is likely to have a negative credit impact for Indian banks. Moody's thinks so. Let's get in Srikanth Vadlamani. He is the Vice President, Financial Institutions Group at Moody's. Srikanth, thanks very much for joining us. Throw some more light on this. Why does Moody's believe that this is a credit negative for Indian banks?
So this is predominantly because there is an interest rate risk that is inherent to a banking business. And these norms sort of limit the flexibility of the banks to manage that interest rate risk. So on the asset side of the balance sheet, now their loans are linked to an external benchmark, let's say the repo rate. Whereas on the liability side, which is the deposits, it is not linked to an external benchmark. So it is possible that there could be scenarios where the repo rate goes up a lot, but the funding costs don't move up, and hence the NIMs benefit. There could also be scenarios where the opposite happens, where the repo rate comes down and hence the lending rates come down, but either because of liquidity situation or some other situation, the funding costs don't move, and hence there would be a NIM contraction. In the current scenario, because the lending rates are linked to a particular bank's funding costs, this sort of mismatch won't be there. But going forward, the ability of the banks to manage their interest rate risk would be limited by these norms.
But do you feel that this exposure that the banks have in terms of the volatility and with the kind of accounts that they have the exposure to could be limited, and there could be other instruments that could counterbalance this?
Sure, I mean, there could be mitigants. I mean, the near term, the fact that only the new loans would be repriced would mean that the impact would only be felt over the medium term. The fact that the entire loan book is not being repriced, but only the retail and SME part also mitigates. There could be potentially some sort of making the funding costs also variable by linking it to some sort of variable benchmarks. But having said, even after assuming a lot of this is done, while some of these risks would be mitigated, I don't think it is possible to take out these risks. And the fundamental point is that there is no standard benchmark in India which can translate movement in the overall interest rates to movements in the funding costs. So there is always the risk of benchmark selection that would be there. We also need to keep in mind that most of the funding in India is from the retail, and it is typically of fixed tenure. So it remains to be seen whether it is possible to have sort of a floating rate liability base as well. And that would require a behavioral change, and we are not yet sure if the Indian market is there yet.
The direct linkage now, as you also highlighted, between the lending rates and the funding costs actually no longer exists with this external benchmarking. How big a gap does it leave? And do you think that is materially negative for the Indian banks, considering the setup and the bifurcations that you have with regards to some banks having a higher CASA, some banks having exposure to other higher corporate loans, bulk deposits? I mean, how do you read into all of these variables?
So I mean, let's take CASA for instance, right? CASA is a very high quality deposit. All banks want to have CASA. It is sticky, it is low cost, but it's also a fixed cost. So for example, on the current accounts, which is the CA part of CASA, the interest rate is zero, so you can't really change that. Similarly, in terms of savings deposits, the interest rates are low, around 3 or 3.5%, but they don't tend to move with the interest rate cycle. So in some sense, it's sort of paradoxical that banks with higher CASA may see more volatility because a bigger part of their funding cost is fixed. So across the cycle, probably this will not have an impact because periods of contraction in interest in NIMs will be compensated by periods in expansion in NIMs. But what it does is that it lends to more volatility in the bottom line, which is the negative here.
With regards to the fact that we've already seen that some of the banks have put a limit below which they'll go in terms of the CASA deposit interest rate that they're going to give. So in terms of the volatility, and if you do see a period where the external benchmark interest rate sees a significant decline, will these banks be able to counterbalance the same if they've got a lower limit in terms of what they'll do with the interest rates on the deposits?
I'm not sure. I mean, on the term deposits, they certainly, I think the term deposits will broadly move with the broader interest rates in the economy, although they won't be a one-to-one move, and hence they will always be mismatched there. On the savings deposit front, we are not very sure if the lower limits can be breached, because the point is that on a savings deposit you're already offering a very low rate at 3% for instance right now. Hence, would you want to take down the 3% to 2%? What would be the customer reaction to that? So these are things that we will only know when we get there, but to us it's not obvious that the elasticity of the savings deposits will be as high as it is there for the term deposits in terms of the interest rate movements.
Okay. How does the bank look to mitigate this extreme volatility that it could face with this external benchmarking, and not just the fact that they have to balance it out, but also the kind of instrument that they choose to externally benchmark, whether it be the repo, whether it be the treasury bill, and the volatility that each of these instruments witness?
See, the logical way of doing it is that if you have got a floating rate asset side, you need to have a corresponding floating rate liability side so that the interest rate risk is automatically cancelled out. And that's what the banks will try to do. But the challenge is in execution. Because one, you need to get a benchmark. Which is the benchmark you're going to take, and would that benchmark be a good indicator of how your funding costs can happen? For example, there could be scenarios where you should be prepared to pay more than the market as far as the funding cost is there. So let's say you are benchmarking yourself to the repo rate, whereas existing in the past, maybe let's say for the sake of argument that you are paying repo plus 50 basis points, and sometimes you'll be prepared to pay repo plus 100 basis points, and hence there is a sort of a mismatch that comes in. So these sort of mismatches I don't think can be totally taken out, and that's why I think there would be some inherent volatility that would be there in the P&Ls going forward.
How easy or difficult is it for a bank to select from the 4 external benchmarks that has been provided to them, and the inherent risk of volatility of each of them? Mostly all the conversations that we have surrounded the fact that most of the banks are going to link towards the repo rate, but also the fact that we see certificate of deposits rate, they don't closely track the movement of the treasury bill rate. So it's going to be a sort of a dilemma for banks in which instrument they actually choose.
Absolutely, and there is no right answer to this. Benchmark selection is going to be a problem, because the thing is that repo rate is the RBI policy rate. Now, whether that gets transmitted to the other interest rates in the economy depends upon other factors. For instance, liquidity plays a major factor, and we have seen that over the last year. We have seen the repo rates coming down, but the rates haven't transmitted to the other interest rates in the economy because the liquidity situation was a bit tighter, and it will move the other way when the liquidity situation is in surplus. So you will not have a single two bench. Like if you, let's say you're linking your asset side to the repo, it's very difficult to say that if you link your liability side to, let's say, the CD rate, the repo rate and the CD rate will move in sync. It hasn't happened. We have seen that in the past. So this benchmark risk will remain. And that is the point. That is why we think that this lends volatility. It's not that there is a right benchmark that banks have to find, and once they get it, the problem is solved. A benchmark which is right in a current environment may turn out to be not so perfect in a different scenario. And the issue is that obviously the banks can't keep on changing their benchmarks. So the benchmark risk is something that I don't think can be fully mitigated.
Mm-hmm. We touched upon this briefly, but I just want to know your thoughts on the fact that these new rules will actually impede the ability of banks to reflect the cost of funding, the changing cost of funds that at variable periods they'll end up paying, and translate them into the lending rates, which are connected to the external benchmark.
Yeah, so I mean, the way to understand it is it's not that it is directionally always negative for profitability. There could be scenarios where they benefit. For example, let's say the system is surplus with liquidity, then the impact on the other interest rates in the economy will be much more than what a change in the repo rate is. And in such a scenario, the bank's lending yields will be lower by a lower extent compared to how much the decline in their funding costs are. But it could happen the other way as well. So it's not that it's directionally fully negative. It's just that you cannot predict with certainty, for example, how the NIMs are going to happen, how the profitability is going to come through, because in some sense it would be at least a part of it would be outside of the bank's hands. Of course, this can be mitigated if the financial markets are developed enough, if there is enough sophistication in the financial markets that there are instruments available through which these risks can be hedged. But I'm not sure if the Indian market is at a stage where those instruments are available in the level of liquidity that is required for banks to fully hedge out these sort of risks.
Okay, and also just on a comparative basis, and how you would gauge volatility for banks with a stronger deposit franchise versus banks with a weaker deposit franchise, and how different variables would play out for each of them.
See, so for banks with stronger deposit franchise, the proxy is that they have a stronger CASA, so they would be more impacted by movement in market interest rates. So they would be more impacted by the benchmark risk. So if the benchmark they choose is not moving with the benchmark they have on the, let's say they chose CDs, the CD rate as a benchmark, and let's say there is the repo rate and the CD rates are not moving in sync, they would be more impacted in such a scenario. Whereas banks with weaker deposit franchises would be more impacted by their idiosyncratic need for funding. So let's say a company in a particular scenario, a bank in a particular scenario decides that it needs more funding and hence it has to pay higher than market rates, then it will be impacted more because it can't reflect those higher funding costs on the asset side.
Okay, and one last question. All in all, what did you make of this move with regards to how the transmission now will take place into the system?
So definitely the transmission should be better because in some sense there's a lot of flexibility that has been taken out. So if I'm a bank and I've told my borrower that I'm going to give you repo plus X, if the repo rate moves, the lending rate has to move correspondingly. So the transmission, I think, would be better now. But at the same time, transmission is also a function of interest rates and also credit availability. So there could also be scenarios where banks could say that, fine, this is the interest rate at which I have to lend, but I don't want to lend at those interest rates because it doesn't make sense for me. Hence, the volume of credit can be constrained.
Okay, got that. Srikanth, it was really a pleasure chatting with you. Thank you so very much for joining in.
Thank you.